Please take notes. While trading can be rewarding, it comes with high level of risk and you can lose all your funds. And also note that videos on this channel are for educational purposes only. None is intended as investment advice. Please do your own research and also consult your financial advisor if you need one. Thank you. All right, you're welcome back. So this is lesson 1.2, understanding currency pairs. And the main objective for this particular lesson is to help you learn how currency pairs work and to also learn how to read them. Right? Because when you have that understanding, you're able to navigate through the markets. All right, so let's make progress. All right, so now currency pairs consist of two currencies: the base currency, which is the very first currency pair, currency in the pair. Okay, it's always usually on the left side of the pair, and the quote currency, which is the second currency. Now, let me explain currency pairs in terms of your shoes, your pair of shoes, or your pair of slippers, or your pair of sandals. All right, so you have your pair of shoes, sandals, or slippers. The slippers on your left side is the base currency, while the slippers or the shoe or the sandals on your right side is the quote or counter currency. Get that? Beautiful. So now, like now, look at Euro USD. Euro USD is on the left side, while USD is on, Euro rather is on the left side, while USD is on the right side. Okay, so the Euro here is the base currency, while the US dollar is the quote or counter currency. Now, the value of the pair indicates how much of the quote currency is needed to purchase 1 unit, just 1 unit of the base currency. Now, which also goes to explain that the base currency value is always one, right? So it is a counter or quote currency value that fluctuates. The counter or quote currency value is what fluctuates, or it goes up and down. Sometimes it could be less than one, sometimes it could be more than one, sometimes it could even be 2, 20. For example, when you look at an instrument or asset like gold, XAU USD, XAU USD, as at this morning, while I'm recording this video, gold price is above $3,000, but 1 unit of gold, the base currency, is over $3,000. So when you also consider an asset like Bitcoin, okay, is the base currency in BTC USD. So 1 unit of the BTC is over 70,000 US dollars. I hope you now understand that. All right, let's make progress. So how to read quote currencies? Currency quotes are typically presented in two prices. You have the bid price, which is the price at which the market will buy the base currency. Now, when you say the market will buy the base currency, it could be market makers, it could be your broker, buying from whoever is holding, whoever wants to sell it, which is you in this case. And then the ask price is the price at which the market will sell the base currency to who? To you, who are the buyer. You get this. By the time we get into the practical section on the charts on the trading platforms on your smartphone or on the laptop or on your laptop, you are going to understand it better. But just take note of this, write it down, take note of it, and repeat it again and again and again. That the currency quotes are presented in two prices: the bid price, the ask price. The bid price is the price at which the market will buy the base currency, while the ask price is the price at which the market will sell the base currency. So the difference between the two prices, that's the bid price and the ask price, the difference between them is known as spread. You will learn more about this as we make progress. Now let's look at an example first. Theoretical example, Euro USD. So if the Euro USD pair is quoted at 1.1200 the bid price and 1.1205 as the ask price. Now you have the bid price being 1.1200 and then the ask price 1.1205. 0.005. So here the spread here is what? 5. By the time you deduct, make all deduction, you now have 0.0005. All right, let's look at types of currency pairs. You have major pairs. Major pairs are the most traded currency pairs and typically include the US dollar, USD, as one of the currencies. They are known for their high liquidity and lower spreads. They are known for their high liquidity and lower spreads. They are also the most manipulated. Yeah, they are also the most manipulated. Examples of major pairs include the Euro USD, which is the most traded and most manipulated pair in the whole world. USD JPY, all right, which is US dollar and Japanese yen, popular among traders due to its volatility. Then you have GBP USD, British pound US dollar, known as cable, and it is heavily influenced by economic data from the UK and the US. Then you have USD CHF, USD CHF, US dollar Swiss franc, and then it's often considered as safe haven currency pair because the Swiss actually have their country reserve in gold. So now you have minor currency pairs. Minor currency pairs do not include the US dollar, but they involve other major currencies. They tend to have lower liquidity compared to major pairs. Examples include AUD which reflects the economic relationship between Australia and New Zealand, GBP CAD, which represents or which is influenced by oil prices and economic data from both countries. And then you have Euro GBP, which is important for traders focusing on the European and the UK markets. Then you have exotic pairs. These exotic pairs consist of one major currency and one currency from a developing or smaller economy. Okay, exotic pairs can be more volatile and have wider spreads. Examples include USD Tri, that's Turkish lira, US dollar and Turkish lira. And this is often influenced by geopolitical events and economic instability in Turkey. Then you have the Euro SEK, which is Euro and Swedish krona, reflecting the economic relationship between the Eurozone and Sweden. And then you have the USD ZAR. USD ZAR is US dollar versus the South African rand, influenced by commodity prices and economic conditions in South Africa. Okay, so let's head over quickly to understanding spreads and volatility. Very important because if you don't understand this, all right, if you've had stop loss hunting before, this is where the issue comes when you don't understand spreads and volatility. So let's quickly head over to it. Spread. Spread, like I mentioned earlier on, is the difference between the bid and ask price. Then major pairs typically have tighter spreads due to higher liquidity, while exotic pairs may have wider spreads. Some exotic pairs can even have up to 50 pips spread. Volatility refers to the degree of variation in trading prices over time. The degree of variation in trading prices over time. Price change. That's volatility. So in forex trading, volatility can be influenced by several factors, including the following. Number one, you have economic data releases. Key economic indicators such as GDP, employment figures, inflation rates, interest rates, bank statements, all of these, I mean, are not your personal bank statement, countries, bank statements of countries and nations, all right, big nations, US, Canada, Europe, Bank of England, okay, central banks. So then another event is geopolitical events that can affect volatility. Political instability, elections, and international relations can lead to increased volatility in currency pairs, generally financial assets. Once there is political instability, expect it to affect the markets. Then you have market sentiment. This has to do with your perception or the perception of traders and reactions to news. All right, when these happen, they can create rapid price changes, especially in major pairs. Now let's consider types of spread. Types of spread. They have fixed spread. Now Spread already is the difference between the bid and ask price, you know that. But now with fixed spread, it remains constant regardless of market conditions. It doesn't change. Now, the benefit of this is that it can provide predictability for traders. A drawdown for it is that if the broker has given you spread, that's what you maintain. It may be higher than what you can get elsewhere. In fact, it will be higher in most cases than the other type of spread I'm about to mention to you. So you have variable or floating spread. This spread can change based on market conditions, liquidity, and volatility. So sometimes it can even shrink to less than one. In fact, sometimes to zero, all right, as it's fluctuating. Okay, and it means that during high volatility, the spreads may widen. And what this does is to increase your trading costs. So this is the drawdown to variable spread. Variable spread have they tend to have narrow spread. They have a narrow spread. Yeah, the spreads are very tight. Sometimes one and less than one. While for fixed spread, sometimes it can be 1.5, 2, or even 3, 4, 5 or more. But the beautiful thing about fixed spreads is that it remains constant no matter what's going on. But for variable spreads, you may have 0.01, you may have less than one pip spread when the market is quiet, and as soon as volatility sets in, that one pip or less than one pip can even rise to as high as 10 pips. And what that could translate to is what many newbie traders complain about. Oh, I set my stop loss, and then after the market moved and it got to my stop loss, it didn't take it. No, what happened was that the spread was widened during that period because of high volatility. So take note of that. So that's why I recommend for a beginner, please choose fixed spread. Okay, I'm already recommending it ahead of time. Commission-based spread, some brokers will charge a commission on trades instead of widening the spread. This can be beneficial for high frequency traders who prefer lower spread. So another way, if you don't want fixed spread, go for commission-based spreads where they have fixed commission. All right, and then the spread is tight. So you pay spread still and still pay commission. While there are still some brokers that will give you zero spread and be charging you commission according to whatever they think. All right, so but I recommend you go for fixed spread to be safe. Importance of understanding spread and volatility. Number one is cost of trading. When you know the spread, it helps you to calculate the cost of entering and exiting trades. Tighter spreads can lead to lower trading costs. Second is risk management. Understanding volatility is crucial for setting stop loss and take profit levels. If you've heard about SL hunting or stop loss hunting before, volatility is the issue. All right. So when you understand volatility, you know, oh, I can, in fact, that's where I even recommend you trading fewer number of times, taking fewer trades per week. All right. And when you are doing that, you want to maybe run swing trade analysis. Yeah, run swing trade analysis where your SL can be wide, yes, and your TP2 can be very wide as well. And so with that, you will just realize that if you get the trend correct, you win most of the time. You take fewer trades and win most of the time because by the time it moves in your favor, you would have locked in, move your SL to lock in some profits and then allow it if you want to get to your TP or not. Higher volatility may require wider stop loss orders to avoid being prematurely stopped out. Trading strategy. Different trading strategies can be more effective in varying volatility conditions. For example, scalping strategies may work better in low volatility environments, while swing trading may benefit from higher volatility. That's what I just explained, right? So if you, for starters, I encourage you to do swing trading rather than scalping. But if you want to learn scalping, no problem. Okay, summary of this lesson 1.2. Currency pairs are categorized into major, minor, and exotic pairs, each with unique characteristics. Understanding spreads and volatility is essential for effective trading as they impact trading costs and risk management. I hope you understand this. Please, if you don't at any point, or if you lost me at any point, please just replay the video, okay? Make notes, understand what has just been taught here. And if you have any questions, note them down and you can ask either in the comment section here or you can ask in the group on the platform, all right, where we give signals. So, and if you want to join our training and to get all our trading signals too, check in the description of this video also. If you are not there and come in there, you'll be given free signals for 2 weeks on a demo account, and thereafter you can receive free signals for 6 months. But please note that nothing said in this video is an investment advice. Everything here is for educational purpose. All right. So see you in the next lesson 1.3. We'll be dealing with market structure theory yet. Thank you very much and God bless you.